Alright, I get asked this question a lot and I wanted to make a short and sweet video. So, what is a cash secured put? So in order to understand what a cash secured put is, you're first going to want to understand the two main ways that stocks generate yield for investors. The first one is to buy a stock at a price and sell it at another price. So imagine you bought SoFi around $10 and you sold it for $30. You would get that gain between the two prices of $20. Another way stocks generate a return is to pay some of their earnings out as a dividend to investors. You would collect that yield, which is usually less than a percent or a couple percent for most stocks. Those are usually paid out on a quarterly basis. Some of them are paid out monthly. So we know the two ways that stocks generate a return. Important to know about puts selling. Remember, a cash secured put is selling. Is the collateral is cash. You get that cash up front. Premium is cash. The trade is realized when it's closed or expired. And it's selling an option. It's not buying. So you're essentially like a mini market maker. You're selling the put to someone buying it. So what is an option? An option is just a contract to do something in the future. A put is agreeing to buy it at a certain price in the future. Usually the price is at or below the current price, and bought puts allow for downside exposure. So you're selling usually that put to someone who believes that the asset is going to go down and they want to benefit from that, or they're hedging a position to protect from downside by being able to sell the stock at that price or gain a profit from that move. Contracts always deal with 100 shares at a time. So a single put contract controls 100 shares of yield. And also options allow exposure with potentially less upfront collateral. But we don't need to go into that today. So let's go to our little calculator and look at SoFi. So imagine tomorrow's Monday. You only want to buy SoFi at 25 bucks, right? So you want to buy it at 25 bucks. 25 times 100 is 2500. That's your collateral. And you're doing a single trade that's going to end on Friday. It's a 5-day trade. That would be a 204.4% yield if you were to replicate this trade throughout the entire year. Obviously, it's not that simple, but this just sort of helps you gauge and compare APYs between different stocks and different trade setups that you could possibly have. And that's about as simple as we can make it. Important to note is you can close your trade whenever you want. So you always want to be trading, always want high open interest, which means volume of that contract, so you can exit when you want, or you can simply let it expire. If SoFi stays above 25 bucks on Friday, you get to keep your 70 bucks. You get your $2,500 collateral back, and you can rinse and repeat. If it drops to 24 by Friday, you're buying 100 shares at 25, even though the stock is at 24. But you collected this 70 bucks. So instead of being down 100 bucks, you're only down 30 bucks. If you do this enough, it eventually manufactures a winning scenario the more you know about options.